Beat Nussbaumer from macrobeat.co.uk. Yesterday, we finally had the long-awaited speech from Fed Chair Powell at Jackson Hole, a speech that was sort of hyped up to be at the level of the 1995 speech from Paul Volcker. Back then, obviously, it was about too much inflation. Right now, it's obviously about too little inflation. I think things went sort of as expected. Fed Powell did announce the average inflation targeting, which obviously is a dovish element in its policy armory, and this was really what the market did expect to hear. He didn't really go further into detail, so there was a bit of an element where we run into a little bit of a vacuum yesterday. We sort of, the first reaction being a buy the rumor, buy the fact, which then turned into the buy the rumor, sell the fact, where the dollar had put on quite a bit of a rally. Gold collapsed about 3.5%. But again, this was probably more to do with people sort of buying bad levels in the euro or in gold after or during the speech. And then after we didn't see really any follow through, people just panicked on the other side. Today, now everything looks as if it was meant to happen the way it did. Dollar is back weaker, gold is back higher, which we will look at later on. Jay Powell didn't really indicate how much the Fed would be prepared to let inflation exceed the 2% target. Fed's Kaplan was on the way later in the day, talking about 2.25% to 2.5%, which may just be sort of slight breach of the 2% area. A lot of focus obviously on the unemployment number. So this time the Fed, if the unemployment number starts to come off, doesn't necessarily mean they will hike rates to sort of start to soften it up. Given where unemployment rate is now post-COVID, which is hovering around 10% and is expected to only come down very, very slowly, the Fed basically told us yesterday there'd be no rate hike probably for the next 4 to 5 years. That having been said, they were just the first ones to really come out to admit that, while the rest of the world probably still has to follow at some point in time. So the first reaction, weaker dollar, higher stock market, which we'll talk through the slides, what I would expect going forward. On the first slide, this is the euro-dollar daily. Just to quickly see, we had this quick run up to 119, big sell-off down to 117.5, and we are back at 119. So as I said, we had this sort of wild market yesterday, and now as the market settles, we are more towards sort of a dollar weaker environment. The only reason why I'm not too excited in the short term is the fact that the EU-US data surprise index has shifted in favor of the US again in the last sort of week or week and a half. That means the top side in the euro, in my opinion, is still a little bit limited. It's quite a surprise the way the US data is holding up, and it was quite a surprise how weak the European data have become so quickly. So we might just end up in a bit of a sideways range with a small tilt towards dollar weakness. On the next slide, this is the Euro Weekly. This is a sort of 12-year trend line, which we trade above. So we do see there's obviously the sort of progress on the euro on the top side of the weaker dollar. I still think 120, 120.5 for now might be it. My overall target has been 125, but as I said, since the data index shifted a little bit, I would need to see either more European data strength or US weakness to actually start to go back on that trade. For now, I think 170 and 120 may just cover it. On the next slide, we have the dollar index. It's the same. We're still more or less in the same range that we have seen in the last few weeks. A break of 91.90 would really be the one that would be needed to send the dollar a lot lower. I'm not convinced that's going to happen anytime soon, so I would not be surprised to have be stuck in the same range for a few more weeks. The Dow on the next slide. Yes, we just continue going higher. I continue to eat humble pie, but because I haven't really talked about the Dow is going to collapse, I at least didn't have to eat that much humble pie of late. The market remains supported. There's just nothing in the way right now other than at some point if the data really starts to disappoint. But at this point, with the Feds giving the green light in terms of easy money, there's just nowhere to go other than probably continue to grind higher. Last but not least, gold. Big volatility yesterday. We stay above this 1925 area, and gold is still poised to go higher. That's me, Beat Nussbaumer. Bye-bye.